Welcome to Ask an Advisor, where we here at Team Clark go deeper on all things investing and saving your money for your future.
Kristen Ebias.
Wes Moss. Hello, Wes.
Good to see you.
Today, a couple of really interesting things. First, I know you're going to talk to specifically about small business owners, and many are feeling a cash crunch right now.
What do you do if you have a cash crunch? What are the accounts? What's the right way to solve a temporary valley, let's say, in your cash flow? And there's a lot of different ways to approach it. So we'll talk that through and some of the rules.
Mm-hmm. And then on Friday, Clark spoke about jobs, unemployment, his predictions for the rest of the year. But you have some really interesting numbers and a perspective on the latest jobs report that is a different take than what Clark had.
Well, it is. We just got jobs numbers, so we just kind of played catch up because we've had two. We had a government shutdown and then a partial shutdown, and that delayed job numbers, and then it delayed it again. And we just recently now have pretty much a full job picture, so we can really do an assessment now. And I'd say it's not a glowing report, but it's better than I thought it was going to be.
And different depending on your education level. I saw a couple of your snuck a peek at a couple of your charts, and I'm really interested in what you're going to say about that too.
Well, let's start with this. And there's so much churn in this economy, and there's a variety of reasons. I think that when you go through technological change, like we're seeing at such a rapid rate, if you think about the announcements, I follow this, and you get a new announcement, and it's not just every week, but sometimes we'll see new announcements with new AI developments in a day, or even two in a given day. One company will release a new way to code quicker. Then the next company or competitor will do the same thing in later that afternoon. And it may not directly impact every single industry. In fact, there's some industries it doesn't have an impact on. But it's a rumbling, and it's a little bit of an economic earthquake. And that filters through to almost every industry, at least at some level, some more than others. And I've seen with some small business owners over the past couple of months, people kind of raising their hand and saying, gosh, things are impacting my business. And even if it's not AI related, small business owners frequently have to manage cash flow. What if you've got a good quarter going, or a good 6 months are going, but your client is late to pay and you want money in 30 days, but they say, well, I'm not going to get it to you until 60 days or 90 days. So that happens all the time, even in a good economy. So this was a situation, we'll call him Connor, small business owner in his 40s, let's say running a marketing agency, and has a pretty good runway for client base and revenue outlook for this year. But someone has been late paying their checks, and so he's not getting paid. So he has a couple clients that have been delaying their checks to him and paying their bills. So now he's looking around and saying, well, I know the money's supposed to be coming in, but I may have a whole month where I've got to go back to my personal money. And this is the conundrum that any small business owner, I'm sure, has had to at least think about or execute on. He's got to go to his own pocket to fund the business while he's waiting for that lack of cash flow. He thinks it'll get resolved, but it's not going to get resolved in the next week or two, and he has bills to pay. So what does he do? So he looks around and he says, well, I could pull money out of my brokerage account. What should I do that, Wes? Or I've got this Roth money, which is a sacred place. It's a sacred chest with jewels on it, and you don't want to touch it. But in the end, we got to pay the bills. So the question is, can he tap the Roth account? What should Connor do? The simple, clean way to do this, and the easy answer, is you go to the brokerage account. There's no penalties, restrictions, but there are taxes, and the market's been strong over the last 5 years, and his stocks are up. They're all up. And if he were to sell some of those stocks, he's going to pay capital gains. Now, the good thing about that is that we know what the rate is, and it's lower than the income tax rate in most instances. For him, it'd be about 15% only on his gain. So that's one easy way to do it. But he said, well, what about my Roth? Well, let's just do round numbers here. He contributed $15,000 to the Roth let's call it 5+ years ago. The Roth is worth over 50. So he's eyeing that, and I said, well, if you need 10,000, maybe brokerage. If you need 10,000, maybe you just take, and we talk about this all the time, but we don't talk about the logistics of this. Remember, your Roth contributions, because they're after tax, those are free and clear. Mm-hmm. You can pull out your contributions, you don't pay taxes on them, and you don't pay penalties on them. So in his case, I said, look, if you need 10 to 12,000 to float you through this period of time, just use your contributions. Because even if you can't pay it back into the Roth, which is the next twist on this, which is the 60-day rollover window, then you're still not going to be taxed or penalized if you're taking the contributions or anything less than that. That is something that I just want to remind everyone about, is that they are accessible. I know it's this sacred chest, do not touch, but if you need the money to float yourself, particularly for small business owners, it is accessible. Contributions can come out tax-free, penalty-free. Now, he said, well, I think I might need more than that. What about the whole account? What about the whole 50? Whoa, what about the whole 50? Well, we know the contributions are fine, but the rest of that, because he's in his 40s, would be taxed and penalized. But here's the key. This is a period of time he needs to cover. It might be a month. Well, the good news is there's a 60-day re-rollover window, so that if he takes the full 50 out, he has a full 60 days to put that money back in, and it's as if it never happened. Now, how does this actually work? You end up getting a 1099-R, which is a retirement distribution form, and then you end up with a form 5498 that shows essentially that you have a net zero withdrawal because you put all the money back. The nuances around it are, is the 61 days and the whole thing gets blown up. It's got to be 60 days or less. That's very important. And you can only do this one time per year. You can't float yourself 2 different times during the same year, even if you put the money back. So those are the rules around using Roth money. And he thinks it really will be more like 30 or 40 days. So that's what he's going to do. Take out Roth money, put it back in within 60 days. It's a way to cover a cash crunch shortfall, float yourself. It's your own money. We just want you to be able to access it in the most efficient way. Mm-hmm.
Okay. This question came in for you from Jefferson. He says, I'm in my early 40s with a portfolio of over $2 million. What are your thoughts on small caps? Do you feel they're set up for a great run since they've underperformed for so long? I currently have 18% of my portfolio in small cap value. What are your thoughts?
Jackson, over the last 5 years, here's how it's gone. Ultra mega cap growth has been the right place to be, the best place to be, followed by large cap value, followed by small cap growth, followed by at the bottom of the barrel has been small cap value. It's still done well over the last 5 years, but if you look at large cap growth, the numbers are double or triple. We still made money, but it hasn't been nearly as much. There is this property, it's almost like gravity in the investment world, which is reversion to the mean. Over long periods of time, small caps have actually done better than large. We've had a run where large has done better than small. So the gravity here, the reversion to the mean, is very likely that small caps and then categories like small cap value should play some catch up if we get reversion to the mean. Interestingly, in 2026 so far, we've seen a real reversion away from large cap into small cap, and you've seen the small cap indices do really well relative to large. And that's not just been 2026, but it's really been towards the end of 2025 that started to happen. So we have seen this rotation already happening. Are we farther enough in to say this is a new permanent reversion of the mean that'll last for years? Maybe a little too early to say that yet, but at your age, in your 40s, having 18% in small cap and some of that in small cap value, it doesn't seem like too much to me. What you're doing, it's diversification. remember, the S&P 500 isn't overly diversified because it's so heavy. 40% of the companies are basically in the top 10 names. So it's not that diversified. In order to be diversified, you're going to have to add in ETFs or funds or individual positions that are in these other categories. So that's really what you're doing. I think it's a good thing, and I don't think 18%, as long as you have a higher risk tolerance, is totally fine.
Okay, and this one came in from Eric in North Carolina. I was recently cleaning out some old files and found my credit union statements from the late 1990s. So many surprises. I was startled to find my social security number on every statement, which I immediately shredded, but I was even more surprised to see the interest rates. I had a 6.75% mortgage through my credit union, which was not unreasonable back in the day, but the shocker was that my savings account was giving me 6%. I'm still with the same credit union, which now provides me with a paltry 0.25% rate on that same savings account. What happened? With the return of higher interest rates over the past 5 years, why haven't our banks increased the rate of return for these accounts accordingly?
Eric, it's unacceptable. That kind of interest rate in the world today. Think about this. 6.75% in the 90s. That was your mortgage rate. That's where rates are right now. So why isn't your savings rate paying you that? It has to do with the federal funds rate. But the federal funds rate is 3.5 to 3.75, almost 4. And a money market fund right now should be paying 3.5 to 4%. So you're getting hosed by your credit union. And credit union, well, I did address your Social Security statements. It's good that you shredded them. If you really look at the numbers, there were 274 million Social Security numbers that were ousted last year. So I think that there's probably 3 Social Security numbers for every person in the United States floating around somewhere on the dark web. So it's everyone times 3. But do everything you can to protect against that, freeze credit. Make sure you're using multi-factor authentication in all your investment and banking accounts. That's kind of table stakes for the world we live in today.
Sure. Our health insurance cards used to have them right on them. Medicare cards had them on them forever. I mean, they've finally gotten that number off of pretty much everything.
But we need diligence around that in order to.
Oh, yeah.
We just have to know have all been exposed many times.
Freeze your credit.
But on to the rate, it is your job now to make sure that if you have a larger chunk of money, it's going to sit in cash and it's part of your dry powder, then it should be at least getting 3.5% or higher in the interest rate environment we're in today. Banks and credit unions, particularly the large banks, they are famous for not paying you. And that's how they make their money. So the net interest margin is the biggest thing that's their biggest revenue source. They're lending money out at 6 or 7%. And if they're paying you 3.5%, they're making a fair amount of money on the difference. If they're paying you 0.25%, they're making a fortune. So it's incumbent on you, Eric, to make sure that money gets into a money market or a high yield savings account. They're not going to do it for you because that's how they make a living. Brokerage firms do this, and it's the inertia of staying still. Mm-hmm. An object at rest tends to stay at rest. And right now, you're at rest. The money market's just sitting there. A lot of functional bank accounts, though, checking accounts where there's lots of money coming in and out and writing checks, a lot of times those don't pay much. But that's why you want your functional cash to have enough in there to make sure you can easily pay bills. But once you have that amount, whether it's $5,000 at all times or 10, or depending on your situation, the rest of the cash, let's say you have another $100,000 in safety money, that should be in a high yield savings account, or it should be in a money market. And nobody's going to tap you on the shoulder and say, "Hey, you're losing out here," because they like that interest rate spread. So it's on you, Eric. It's on everyone listening to make sure that anything that's substantial above your real just checking account number value to be at least working for you, but it's on you to do so.
Okay, and then Shelly in Washington sent this one in. Is long-term care insurance worth it? Washington State has a mandatory LTC fund now. It's a very small benefit. My husband's 60, I'm 52. Should we purchase additional long-term care insurance? He has $1.2 million in retirement assets now, not counting our house. He plans to retire in a few years. I'll retire in 10 to 13 years and expect to have $2.5 to $3 million in retirement accounts by then.
Shelly, in Washington, they do have a program for long-term care. I think it's called something like Washington Cares. And most people in the state of Washington do kind of have to. Not everybody does, but you kind of have to pay into it. And it's a little over 0.5%. Almost like FICA. It comes out of your paycheck. But that doesn't cover a whole lot. I think the maximum over time is something like 35 or 40 grand. So it's not enough for long-term.
Oh, no.
Long-term care. But long-term care is tough, Shelly. There's kind of these three categories. If you don't have a whole lot of money, then you have less assets to protect, and you'll end up at some point maybe even using Medicaid. If you're wealthy and you have $3 million plus, you can self-insure your long-term care. It's kind of that muddy middle where you have decent assets, but it's too expensive to even buy long-term care insurance. And there really is no great option. There used to be good options 20 years ago, and they were kind of too good to be true. And long-term care policies were pretty affordable, but they were underpriced, and those companies almost many of them went out of business, and they had great financial hardship because they weren't charging enough for the long-term care benefits they promised people, and that was a problem. So what happened? The rates are up triple, quadruple, quintuple from where they were when it was quote affordable, but it was also unrealistic. So I would, from the numbers you're telling me, you're only 50. You've got another 10 to 12, 13 years of working. Husband's already got $1.2 million. You're going to have 2.5. I want you to be in the self-insured camp. So I don't think you need to go buy a long-term care product or one of the hybrid products that is kind of the least bad option. I want you to think of you having multiple income streams in retirement. Those income streams effectively are your new paycheck for the rest of your life. Social Security, rest of your life. Pensions, the rest of your life. Your investment assets should generate cash flow and income for the rest of your life, and that should be enough to pay for long-term care if and when you need it. And remember, our other spending goes down. So if you're in long-term care, all the other spending kind of goes away. There's nothing. You're no longer discretionarily spending and traveling, so you can refocus your cash flow you built towards your long-term care. And that's the camp, Shelly, I'd like to see you in.
All right. We're going to take a quick break, and we'll get to more of your questions after Wes talks about the latest job reports.
Welcome back to Ask an Advisor. I'm Wes Moss, along with Krista DiBiase, and we are here to answer your questions. And we're going to we're talking jobs.
Yeah, you can submit those questions at clark.com/ask and just let us know if you would like Wes or Clark to answer your question.
State of the U.S. job market and what it means for investors. We've been in kind of this cloud and fog for the better part of almost 6 months. If you go back to October, we had a long government shutdown and shut down the BLS. We didn't get any jobs numbers. You look at unemployment, you look at labor data, it almost looks like there's something wrong with the chart because there's literally a gap. The line goes, it stops, disappears, then it comes back. So we've been in a weird state for trying to figure out how the labor economy is doing. All at the same time, there's so much changing in the labor economy because of AI. So it's been a really uncertain time. We just received kind of a catch up from that plus the partial government shutdown. And now I think we're somewhat caught up when it comes to a real picture of the labor market. And when I first saw the numbers, my initial reaction was, ooh, that's not that good. Because there was a giant revision to 2025 numbers. It was almost a 900,000 person revision lower, meaning the BLS reported these jobs and then they came back and said, oh, no, actually we're almost 1 million over. If you look at those numbers, 2025, on average, we only added about 15,000 jobs a month. That's a low number. We want to see 150,000 jobs, not 15. We're missing a zero.
Yeah.
Now, it's better than losing jobs, but I would call that a no hire / no fire economy. It's really just a flat line. Then if you really understand what they were saying is that those numbers and that revision really is almost, it's very old data. It's from earlier in 2025 and actually goes into some 2024 data. And when it comes to the economy, especially as fast paced as we are today, that's ancient history. So it's not irrelevant, but it's pretty much irrelevant data. What matters is what's happening right now. And even that's a little bit backward looking. That's a little old, but we just got the January report. And again, it takes many weeks for the BLS to compile and report. And that is much better news. If you look at what happened, kind of this, maybe we can call it at least the beginnings of a turnaround. We added 130,000 jobs in January. Unemployment rate down to 4.3%. Historically, that's still super low. The U6 rate, which is the underemployed rate, meaning that you want to work full-time, but maybe you only have a part-time job, that went down a fair amount as well, from 8.4 down to 8%. Wages, which also are accompany the job report, they're up 3.7% year over year. So people are making more money beyond the inflation rate. So that's good. And then I always look at remember we did a show on EPOP, I think we did here, the employment to population ratio of prime age workers. It's the employment of prime age workers to the population. And that's at a really healthy level. That's almost 81% of prime age workers. That's 25 plus, 25, 50 to 54 that want to be working are working. So that's a really, really good number. I would say that in totality, that it's a pretty good jobs report. And I think that's good news. I look at the U.S. EPOP ratio, and I went back to 2021. It was around 76.5. Today, it's at 80.7. That's a 5.6% jump in prime age folks being employed. That's a big move. And that's the number that I think that says the most about the economy. The next piece of the equation is looking at the unemployment rate and I always find this fascinating, per education level. And if we look at where we are today, as education rises, and every time I hear about college isn't worth it and college is too expensive, I think about the way the job numbers really shake out, because we hear that number of 4.4% unemployment, but it's made up, if you break it down by education level, as education levels go up, unemployment levels go down. They go way down. In fact, if you have a college degree or more, the unemployment rate's only 2.9%. So if you have less than high school, it's 5.2. High school only, it's 4.5. Some college, 3.5% unemployment, and then college or college plus, 2.9%. We have seen, though, even the educated group, and the BLS measures all these independently, that has crept up just a little bit. So we're not out of the woods, and I think we're going to continue to see some churn as job roles change because of artificial intelligence.
Sure. I mean, that's been so in the news, like big companies doing huge layoffs of their white collar workers. And
that's very often the case. And the numbers, that I think that's great. It's like chum in the water for media, because you hear of 3,000 layoffs or 7,000 layoffs. Or there was a story about Pizza Hut closing stores. It was 200 stores closing. And I looked up how many Pizza Hut stores there were. There's almost 20,000 of them.
Wow. Okay.
So they're not going to say 1% of pizza stores are closing. They're going to say 200 are closing. That's where we are. And we get the establishment or payroll survey, and then we get the household survey. And from that number, we get this 4.3% unemployment rate, the 8% underemployment rate. But the bigger economic backdrop to me says that if this sticks or this holds, and we have rising labor force participation. We have wage growth, still low overall rate, strong employment to prime age employment numbers. That all supports consumer spending, and that supports an economy that's really not even close to recessionary territory. And then that means that the Federal Reserve is less worried about lowering rates. I think the report tells me, and this is what impacts investors, we're in a stable interest rate environment. I don't think we see rates go much lower from here. The Fed just doesn't need to lower rates all that much. But they also don't need to raise them. So we're in kind of a stable environment, which I think that's a good thing for bond investors. It's also a good thing for equity investors because it means that if the Fed isn't lowering rates, it means we're in a pretty darn good or strong economy. So the corporate profits get to continue to grow, the consumer continues to spend, and that's good for equity markets. So I think the bottom line, pretty good job numbers that we're going to have to monitor, which is in turn really good news for your 401k.
Okay. Would you like some questions
I would
now?
love it. Just fire away. Fire away.
This one came in from Chris in Florida. My wife's a public school teacher, and I work at a public state college. We've both been working in our jobs for 25 years, and we'll both turn 50 this year. We both contribute the max to Roth IRAs through TIAA-CREF. We also have been contributing to the junky 457/403B funds offered by our employers with no match. We have too much in savings and feel we need another investment vehicle. Would our next best option be to open a traditional IRA, or would you also recommend moving our 457 and 403B accounts to the traditional IRA if the fees are high?
Chris, in Florida, as I'm writing 403B, and I did unhappy face, upside down smiley face, because you're the one that's saying it, not me. But yeah, some of these 403B accounts can be crappy.
Yes. For our teachers.
They're annuity-based. They're super expensive. And people just don't like them. Mm-hmm. I see that all the time. And then the 457, Chris, in the state of Florida for you guys, and you're a college teacher. Your wife, it sounds like, is a public school teacher. The 457 should be a little bit better option. Usually, those state plans are less expensive, and if you can lean towards that, you're probably better off long term. But while you're working, if you're under the age of 59 and a half, it's really hard to move these. In a lot of cases, you just can't move them. The IRA is probably not a good move, because a traditional IRA, because you already have probably a relatively high income, both being employed, and you're contributing and you have the 403B, you're probably not getting any sort of deduction for the IRA. So you end up making after-tax, non-deductible IRA contributions, and that gets messy. So I don't think that's the path you want to take here. The eventual path is that once you're 59 and a half, you may be able to do an in-service rollover to an IRA, and then you get to control your own destiny for the 403B. I don't know your exact plan, but it's possible, and I would ask the HR group or the benefit group if you're able to do that now at your age. And then you could have an IRA, and you almost unburden the high fees if you're allowed to do this for your particular 403B. But you're not wrong to want to get this into a more efficient, less burdensome retirement plan. You've got a retirement plan. It's kind of like running in the beach in wet sand with a weight on your back, and that's just not good for your long-term appreciation. So try to get it into a lower fee environment if they'll allow you to do it.
Okay. And Deb in Texas says, you had a listener by the name of Rich that retired in his late 40s, and by all accounts sounds like he's doing great. My question is, he mentioned he expected over $80,000 from Social Security. So when Social Security is paid out, it's locked at the last 35 years of earned wages. If he hasn't had 35 years, the additional years are counted as zero, and benefits are averaged from there. I can't imagine he had 35 years of high income since he retired so young, and Social Security would pay out over $80,000. Am I missing something?
Deb, she's auditing our listener questions. I love that, Deb. On the surface, I think your instinct is totally right. But there's a couple of things here. I bet you, and I don't remember this exact question, but Rich, when he said 80K in Social Security, it's probably for he and his wife. It's probably 2 Social Securities, which would mean they'd both be around 40K a year. And that's totally possible. But to your point, Deb, well, wait a minute, if he only worked 30 years, then you got 5 goose eggs. Social Security it averages your 35 top years. So even if you max it out for 30 years, if you do just the simple math, if you have 5 goose eggs, 30 divided by 35, I want to say is 85. So in your mind, you're thinking, wait a minute, shouldn't that be a 15% reduction in the Social Security? Deb, your instincts are right, but guess the one missing variable here is the fantastical math done by the Social Security Administration. It is not a perfect straight line calculation here. And I've looked at this because I've had a lot of people over the years ask me, like, what if I don't work for a year and I only have 34 years or 33 years? Is that goose egg, the zero income year, does it crush my Social Security? And the answer is it doesn't nearly as much as you might think. If you max out, and this is all hypothetical, but if you max out for, let's say Rich was 49, late 40s, and he's working since age 19, 29, 39, 49. So he's got 30 years. And he happened to be a really high earner in all those years and maxed out still. And even in those younger years, remember, Social Security goes back and adjusts for inflation. So he probably gets a little bit of a lift there. But if you max out over 35 years and you wait till your full retirement age and you get $4,200 a month, then $4,200 a month, 4,200 times 12 is 50 grand times 2. So yeah, you can easily get to 80. But even if you miss 3 years, it doesn't drop by 15%. I'm sorry, even if you miss 5 years. I've looked at this, and the calculation is somewhere in the 5 to 7% range is what I see people drop, even if they have some goose egg years. So he could easily be getting $3,800 a month, and you multiply that by 12, and then that by him and a spouse, and you're over 80.
Okay.
Hold on. Let's just make sure that works. 3,800 times 12, 45. Yeah.
Okay.
So it's totally possible, Deb, but you're right to ask. Thank you.
All right, and this is from Mitch in Ohio. I've had investment/retirement accounts with all of Clark's favorite children plus others, but I've never seen any that showed the full gain and loss of owning an investment. In other words, not just the difference between the purchase cost compared to that day's trading valuation, but also including all the income the investment has produced since I bought it. For example, if an investment is worth $1 less than when I bought it, but has paid thousands of dollars in dividends when I owned it, then I obviously gained by owning it, but the brokerage shows only an incomplete sales-based gain/loss. Especially for retirement accounts for which there are no capital gains taxes or tax loss harvesting, this incomplete sales-based valuation really complicates decision-making.
Totally right, Mitch.
Where can I find a more complete analysis of a genuine gain or loss from owning an investment? And as a related question, maybe one that's impossible to answer, why don't any of the brokerages offer this type of analysis for retirement accounts?
Mitch, totally right. And it is the number one misdirected question I get when it comes to performance. Shouldn't we sell this XYZ thing, or shouldn't I sell this fund or this ETF because it looks like it's made no money? Why? Probably because you're not counting any of the income. And the big brokerage firms just don't have a good way to do that. I don't know why. I think it has to do with the reporting. You can go in on most big platforms and you can see all your reinvested dividends. So you might have 100 reinvested dividends, or let's say every quarter you get a dividend times 10 years. That's 40 reinvested dividends, and it'll keep track of how that reinvested lot did, but it doesn't give you your overall rate of return. It doesn't give you total return. And I don't know why. And I would think you could find this somewhere, but the industry uses secondary platforms in order to see total return. And they'll use big software companies like Black Diamond as an example, Orion as an example. And that's a software that is overlaid to investment accounts because it's tracking total return, which is growth, which seems to be the only thing that most of the big brokerages monitor, and income. If I have a bond or a bond ETF and I put $100,000 in it, and in 10 years, it pays me 6% per year. So I got $60,000 worth of interest. But at the end of that 10 years, the bond itself is still $100,000. Almost every brokerage firm I know shows a 0% return. So Mitch, you're totally right. But you're missing $60,000 in income or a 60% return over that period of time. So you're right, it's misleading. It's like, well, this isn't good, but when in fact it's actually very good. And I think I don't know the right answer, except I don't know how to solve it. I know Y charts that I use. You can find the price return and total return. I know Bloomberg does that, but those are pretty high priced. Those are super high priced subscription services. And then the portfolio management software is not inexpensive either, and that's usually for companies. So the reality, and I've gone on to, let's say, Google Finance or free platforms, and they don't do the total return very well. Mm-hmm. You're just going to have to be really mindful of that. It actually makes it even worse with mutual funds because mutual funds do pay out distributions, and then they raise your basis, and it makes it look like your rate of return is even less. So it's very misleading, Mitch. And my best answer right now, and for everybody watching and listening, is to do not forget your income when it comes to calculating your total return. It matters.
All right. Well, that does it for us for this week's version of Ask an Advisor. We'll be back 1 week from today. Clark will be back tomorrow with a new show, and hope the rest of your day is great.